I want to flip the switch. Have less risk, pay less taxes, pay less fees and costs, have more savings, have more protection, have more retirement income, and pass more to my family.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
Hey, this is John Smallwood, back on Money Isn't, and we are going to be talking about what money isn't today. We're going to focus everything on the concept of term life insurance and how important it is in your financial plan and how stupid it is to hold long term. Okay. Over the last couple of weeks, we've been doing different podcasts with the concept of life insurance. So if you've been following those, this will make a lot of sense. If you're not following those, you might want to go back and watch some of the previous episodes or listen to them on your favorite medium here. But I want to talk about the selection of term insurance on anybody at any point in their life. Now, the older you get, the harder it is to get, and the longer it is that you can't get it, right? But meaning you can't have the longer extended periods. What I want to think about for a second is, and we're going to measure this on the wealth curve, and we're going to show the concepts here of what impact it has on your wealth, okay? Back in the day when I started, all insurance was considered annually renewable term or yearly renewable term, ART, YRT, which many people have this. Still, I encounter it every day, that the premium increases every single year. So it starts off really cheap, and the older you become, the more expensive that policy happens, right? So that as that premium is increasing, it's cheap now, more expensive later. The insurance companies came up with the concept of, we can do 10-year term, and then in the 11th year, the premium goes up. We can do 15-year, 20-year, 30-year, even 40-year level term. Then there's riders that you can throw on. That's going to be a return of premium, which means if I'm paying $500 a year for a policy, the return of premium, they might say, pay us $1,000 and we'll give you back your money when the policy terminates, a certain percentage of that money back. That could be a really good deal. It could be like 7%, could be like 3%. Got to look at what the math is, okay? Then there's the option for convertibility. One of the most important assets, I believe, is your insurability. Okay. Your ability to earn income. Your future is all about it. Your future assets. It's about how much income can you put on the table today and how much you're going to put in the future. And that is the most valuable asset. You create wealth. You have a business that generates a ton of money. You work for a company and you do really, really well. You work for a company and you make $50,000 a year. That's who you are. That has an insurable interest, and we want to make sure that we maximize it, okay? But your health, your insurability is super important. So every term policy, not every, but the majority of term policies that are written have something called a conversion option. And I got to say, it might be the most confusing conversation that we have with clients because they don't understand the value of it, okay? So you can buy a policy that might be convertible to a permanent policy for 5 years, could be for 10 years, could be for 15, could be for 20, probably not 30, could be. And what that means is I can take that term policy and I can exchange it for a permanent policy. A permanent policy is what the company offers. So it could be a universal life. It could be a participating whole life, a non-participating whole life. It could be some derivative of those policies. It could be an index universal life policy. It could be a guaranteed universal life policy. So what people don't do is they don't really understand. Nobody talks about it. The people on the internet aren't talking about it. The people on satellite radio aren't talking about conversion. It's like cheap, 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 right? You get what you pay for when you buy cheap. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. Now, let's talk about ratings for a second. To buy life insurance, there's some medical underwriting that's happening. They're now using social media. They're now using AI. They're using a whole series of things. They're writing to your doctors for attending physician statements. They're making you draw blood. They're making you pee in a cup. They're making, looking at how many prescriptions you're filling. They're looking at your driver's record. All of these things impact your insurability. Like if you have a bad FICO score, that means you do things that they don't like. They're not going to give you the best rating. Okay. It's unbelievable, but that's reality. Okay. So I have super preferred, ultra preferred. That's the top best. And then I might have, preferred. I might have select. I have standard. Then I might have a table A, B, C, D, E, F, and G rating, which means the premium for ultra preferred might be, let's say, $500 a year for the million. And when I get down to standard, it's at $1,000 a year. And every time I get a rating, it might be $1,500, it might be $2,000, it might be 200%, 300%, 400%. If I'm a smoker, that cost is going to be higher. Okay. Because why? We all know why. Okay. So that insurability, if I get ultra preferred today, that means I'm in the top best health and my policy has the right to convert it for 5 years. And in the 6th year, I'm financially successful and I'm doing well. And I realize that I want to have some permanent insurance and I can no longer convert it, but I just battled cancer for the last 5 years after getting that policy. I have to show evidence of insurability, right? That could be good for 10 years. It could be good for the 20 years. So that I don't know on my timeline at 40, if I'm 35 at 40, whether or not I'm still insurable. If I'm still insurable at 45, if I'm at 50, if I'm at 55, I might be financially okay, but I'm no longer insurable. So that means when you visually see what I'm about to show you, the premium goes up exponentially at the end of the level term period. And if I'm uninsurable, I might have to pay that. Because if I'm uninsurable, that means I'm closer to death. So the first thing is that when you're buying the life insurance, you want to buy maximum. You want to buy the maximum for the least amount of cost. And you want to understand how long it's convertible for. And you want to understand, is it convertible to what? Then there's a concept called waiver of premium, which is different for every insurance company. So you got to look under the hood and understand what that means, which says if I add an additional cost to the policy called waiver of premium, the premium will be paid by the insurance company. And some of the policies will automatically convert to a permanent policy. Some of them will convert at the end of the level term. Some of them will not convert to it. So you really got to look under the hood and understand what you have. But if you think about that for a second, if I bought a term policy and I became disabled next year, let's just go back in time for a second. I bought a term policy with a waiver of premium that the waiver says 3 years ago I bought it. Last year I became disabled. When I became disabled and I was out for 6 months, that policy automatically converted to a permanent policy. Now the insurance company, let's say I was paying for $1 million, I was paying $655 a year for the term with waiver of premium that's fully convertible. Now they're paying $15,000 a year, and that policy is building a cash value. By the time I'm 65, that has a significant cash value that I could have been using all the way along that time frame. If the policy waits to the 20th year and that goes from 35 to 55, the premium's substantially higher and it'll do the same thing. And you might want a combination of both, right? But comes down to quality. Then there's long-term care riders. There's a whole, there's child riders that you can add in, right? There's spousal riders that you can add into. But what I want you to focus on is that the most important decision is the quality of the company, the quality of their current products. Now, when you talk about conversion, they're only convertible to the products that the company offers at the time of the conversion. So you have to look at this and say, what is their product makeup? Do they have really good, really well organized, competitive products today? If so, great. Okay. And what's the impact on the conversion when I do it? Is it a really good policy? Like I've seen conversion options from some really, the things that you see, the cheap term that's out there. The policies are horrific on a conversion. Like you wouldn't buy it if you were healthy. You'd want to buy the best product regardless of that time frame. Like if I have a choice, I can buy the best or I can buy the worst in its class. I can buy a well-priced or a cheap one that doesn't have benefits. Which one do you want? I personally like the best. Okay. Now, best sometimes is relative. You have your top tier companies and there's nuances between your top tier companies. When I say top tier, they have strong Comdex and S&P and Moody's ratings. And those products are changing all the time, but they consistently have best in breed products. And they're all kind of like ice cream. They're all good. Like, whether it's chocolate chip mint or, salted caramel, they're both really good. I'm going to be conflicted as which one that I want to choose. All right. Because I like both of those flavors. Those are my two favorite colors. I like coffee ice cream too. Coffee salted caramel is like off the charts. Cookie dough. Tony likes. Okay. So this is not buy it really quick, because the consequences of buying it really quick have a dramatic impact on your financial future. But what I wanted to jump in today is to kind of talk about, I want to use the wealth curve. And if you're listening to this on, while you're driving, go over to the YouTube channel and you'll see the video. Money Isn't, and you'll see it, right? So what I have here is my 35-year-old person. We've got $400,000 saved up in non-qualified assets. We're putting all of that money into the S&P 500. We're looking at his timeline or her timeline from 35 to age 70. I'm going to go to 71 on this. We're going to go out to 71 because I have a spreadsheet that goes to 71. And at 71, and we're looking at a market data interval. We're looking at the stock market from 1988 to 2023. And during that time frame, the average rate of return was 12.42. So those that are driving and listening, I just want you to get the concept here, okay? And what I'm talking about is I want you to understand the potential of the wealth, right? So this compounding, and this is why I want to measure this, right? Every time we measure something and we look at the variables and say, this is not a projection of what it's going to turn out to be. This is a concept, okay? The fallacy in financial planning is that it's like, oh, this is going to happen. This is like Kreskin, like, here's your future. I got the crystal ball. Well, my grandmother gave me a crystal ball the day that I started in this business. And I like to talk with my hands, as you can see, even though I'm Dutch. Okay. So I like to talk with my hands, English also, and a little bit of French Canadian. And the French Canadian grandmother gave it to me and I knocked it off the table and smashed it into a million pieces. So I don't have my crystal ball anymore. Okay. Everything that we look in financial planning is 100% wrong. I'm going to tell you that because every variable in the plan is subject to change. Market, the length of time, the interest rates, the tax rates, so many variables, right? This is not the purpose of this conversation, right? So if I look at this and say, if this person is super successful, they're 35 years old, and they are in a 20% income tax rate, we're not taxing the gains yet, and they're going to make 12.42%, your spreadsheet basically says, we're going to put away $88,000 a year. We're going to make some money. We're going to put all that money back in. Plus, after our lifestyle of $150K, we're going to save some significant money. And by the time I'm 70, this is going to be at $58 million. This is what people's spreadsheets say. And this is why their spreadsheets are 100% freaking wrong. And I want you to understand this, that the mathematical equations don't happen. Okay. So what I want you to think about is, if I have tax on the gains during that time frame, which means there's going to be good years and there's going to be bad years, but if I have tax on the gains, that tax in that last year, the portfolio tax is $599,000. And in this model, I am netting the taxes from the conversation, meaning every year we're pulling taxes out of the portfolio, and that portfolio has dropped from 58 million down to 31.8. Okay. Financial pressure of taxation. Then you hire a really good advisor, and he's inexpensive, and the internal and the external expenses on the thing are 1%. And that 1% over the time frame, which is on everybody's portfolio, drops from 31 to 22.9. Okay. And then there's a concept. Look at this curve. Is this curve going up exponentially every year? And does your market portfolio look like that? I mean, just look at the calendar year, the last 12 months. October, April, 2 years ago, market's down 22%. The ride is a volatile ride, right? And I'm going to tell you, the average rate of return is 12.42. After tax, the pressure adjusted right now is 10.27. Okay. That difference basically costs 58 million to 22 million. When I have volatility adjusted returns, in my book, I talk about this, average versus actual, right? But the volatility adjusted return looks like this type of a ride, okay, where it's going up and down. And that volatility adjusted return, depending upon the sequence of that return, which you cannot predict how it's going to happen, and nobody's putting this into their cash flows, that has reduced the portfolio from 22.9 million down to 15,977,000. Same S&P 500, historical market performance, but the volatility has taken away your wealth potential. And there's an unrealized gain in the portfolio of 1.6 million. Tax. So when I go through this, we look at this and say, the tax is going to come from, and this is what people do not understand. The long part of the portfolio is broken down into three elements. Every portfolio consists of this, where there's dividends, qualified and non-qualified. There's interest. There's realized short-term gains, realized long-term gains, and unrealized long-term gains. Like, how many people were smart enough to buy a really popular stock right now that came out of nowhere and is up way more than the market, and people want to take gains on it, right? You invested 50,000 and it's worth 1.5 million. Like, I got to get some money out of this. You got to pay taxes. Was it short gain or is it long-term? If it's greater than 12 months, it's long-term. Is it going to be taxed at 15 or 20? I don't really know, right? Well, I mean, I do, because I don't know what the current tax rates are, right? But when I do that, that's what's happening in a portfolio. So buy term invest the difference is something that I hear all the time for the last 35 years. It's the mindset that basically says, I don't need life insurance in retirement, which hopefully you got from the last podcast. That doesn't make that much sense, because I'm going to die hopefully after retirement, meaning I live to 65, 70, then retire, live a fruitful, enjoyable retirement, and then die. That's the goal, right? That's the plan. And I have to clean up a bunch of messes after that upon my death. And there's opportunities to increase my retirement income and still pass the maximum amount to my family, right? That's what you want. But I want you to think about, if you're driving, don't do this. If you're sitting and listening to this, do this. If you're watching this, do this. When I start to think about the return on the portfolio is a positive number, right? So there's a positive. The taxes are a negative on the portfolio, right? The higher the taxes, the bigger the negative. And as I compound my portfolio, which is what the miracle of compound interest, I'm also compounding my taxation. And I'm also compounding my fees. So the taxes and the fees are both negatives. So now, when you think about it, if I have a positive rate of return and I have a negative tax and I have a negative fee, that's draining that wealth. And now I go buy life insurance and I buy term insurance. I'm actually creating another negative on the portfolio, which is the term cost. But I'm hoping that I can outlive the concept. I don't need the life insurance when I get to the 100 million, which we know, if you listen to the last podcast, you have other problems then that you may want to solve, then you may not want to because you don't give a shit. That's your choice, right? And our job here is to tell you what's possible. The reason I do this in Money Isn't math. Like, it is a commodity. It is subject to erosion principles, inflation, taxes, transaction costs, fees, corporations coming after it from, style changes to, hey, I just got this beautiful car and they changed the light system on the back of the car and I got to upgrade. That's a style change. That's if the Porsche 911 looked exactly like the 1966 Porsche 911, a lot of people wouldn't be buying new ones, right? So what do they got to do? They got to come out with a new version. It's got to look better. It's got to look wider. It's got to give you that carrot to go buy it. Right? The food labels, the packaging, the marketing, it's all about corporations wanting a piece of your capital, right? So what's interesting is I did this here and I said, let's use the 20-year term policy, and I'm going to bring it up on the screen in a second, but let's use the 20-year term policy that is only convertible for the 10-year period. And I'm using Mass Mutual and their 20-year term policy, and it is $555 for the $1 million of 20 years. So when you see this on the curve, you get this little halo effect that there's a yellow thing that's running, and you basically will see that at 56 years old, the life insurance is gone. Now, this is a really interesting coincidence. If I was averaging my rate of return, my wealth, if I just pick 56 and I'm taking Sharon out and I'm saying, honey, in my spreadsheet at 56, when we started this at 35, we were going to have $6 million. And you can see this on the screen. That's the unvolatility adjusted returns. But because we've been such a good investor and I've been buying the S&P 500 and everything's been great, we actually only have 3.4 million. And that $1 million policy is now at the end of its 20 years, and we have 3.4 million. We don't need the life insurance anymore. And I'm going to freaking drop it. And then I die in a down market, which my father was famous, JP, famous for saying this. Dying is bad enough, but dying in a down market really sucks. So like the year before, the market's down 37%. 2 years before, you guys had this beautiful, 4.1 million, and now we burn up another million in the down market because it's down. So but okay, we're going to do that. That's okay. I want you to think about this, the stupidity of this for a second. we didn't get as much money as we thought we were going to get, honey. And I don't know what the financial pressure is in the future, but everything in our life costs a hell of a lot more than it did. And this has literally just a 3% increase on my salary and a 3% increase on the lifestyle. And, you know, I'm literally making $450,000. When we started, I was making $250,000. And we've got $3.4 million, and our lifestyle is now up to $272,000. And we got college coming, we got weddings coming, we got all this crazy stuff coming that we've been dreaming about. And I'm taking you out for this. You know, we've been married now for, 25 years. This has been wonderful. And I got a bill, and the bill just really, I'm not really happy about this, right? And I think you'll feel the same way. I think because you really want some furniture and, you want some other things, right? So like, where is it? You're looking at my screen. I put all these things in a box to look at it. Where's the term? Term 20. This is the extended coverage protection one, right? Which means it's convertible for the long term. And I'm going to take you out. And the premium was $555 without the waiver. And now it's $10,000. But don't you want the runner, the drapes? Shouldn't we spend that $10,000 on that? And I love you. And I'm going to give up $1 million because I love you so freaking much. like, seriously? Okay. Now, because that's poor planning. But at 70, if I shrink this down now and I go back to 71, right? That $550, that $650 a year term policy has cost us in our retirement, about $80,000 in wealth. But we lost the $1 million death benefit. At $80,000 at 71, that's a nice Bentley that we could have bought. Maybe we don't need the insurance at all because we're, back here on the timeline, right before the 2000 market downturn, we were in the .com phase here, right? And we're kicking ass and we're investing money, and I can't get that to show, but we're making a lot of money and everything's good. We don't need any insurance. That we're trying to cut our budget down. So now you go to somebody and they say, okay, we're looking at the term insurance. We don't want to pay that $10,000. We don't want to pay this 20-year term. So now I'm going to go buy the 40-year term. And I'm going to buy the 40-year term, and it's going to cost $1,570. It's going to cost $1,000 more per year for the next 40 years. So what does that do? That increases my negative. So I got the positive from the return, I got the negative from the taxes, I got the negative from the fees, and now I got a bigger negative on the term premium. Now, every insurance company, what is the mission of a successful insurance company? It is to get the maximum premium from you with the least amount of exposure. If you pee in a cup and they give you the 40-year term, the odds are a 35-year-old at the end of 40 years, that person 40 years later has spent a total of $63,000 in premiums, right? And we're going to give up the $1 million death benefit. And that's what they're banking on, that we're going to get that you'll probably become too expensive somewhere down the line and you'll probably get out of it. But if I put it into the plan and I say, don't buy the 20, buy the 40, or some derivative thereof, right? Buy a 30, buy a 25. There's all the different variations out there. The 40 now, it's the yellow halo goes a lot longer, but now my opportunity cost, and that policy's only got a couple of years left, so you might need to watch your back, right? But hey, we're worth $15 million. And that opportunity cost is $200,000 now on the portfolio. And that's like a really nice Ferrari. And I gave up $1 million death benefit. Now let's go a little bit more macro for a second and put some more pressures. Well, we have 2 kids, 2 colleges. We have a private high school. Got to send those kids to private high school. Maybe I have a wedding or 2, which I didn't add in here, right? So now I get wedding at, 65 years old for, $100,000, and it's going to be for 1 year, and it's a 4% inflation rate. And now that same wealth, why it's still good, all those other factors, instead of having 15 million, I'm down to 8.4. Just from 2 colleges, a private high school, and a wedding. All right? So my point is the financial pressure and the dropping of the coverage at a predetermined age in the future is actually moronic. Okay? And not today, but in the next one, we're going to go through and I'm going to dive into universal life. I'm going to dive into whole life insurance, short pay whole life, long pay whole life, yada, 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 because what the idea is, the mathematics don't make sense, right? If I have a positive rate of return in the market or CD or bond or piece of real estate, and I have a negative on the tax, a negative on the fees, a negative on the term cost, I'd like to turn as many of those negatives to positive as I possibly can. So if I look at my strategy and I'm compounding my fees and compounding my taxes, if I can move money into something where I can grow it without fees and taxes and grow it, I should exponentially have more money. If I can turn the term premium into a positive and put it back into my plan and recapture it, I'm reducing the financial pressure, okay? This conversation is meant to trigger your thinking. Am I doing this right? Because at the age of 35, 45, 55, 65, 70, even 80, I have the possibility to get this on the right track. I have the ability to have something that will be permanent and will be here to age 120, plus or minus, right? How long am I going to live, and how much wealth am I going to create, and how much wealth do I want to protect, and how much money do I want to enjoy in retirement? Because I know this is part of a strategy, right? But you're putting your money in a spot that when I get to retirement, I don't have the freedom to spend it because the protection around that wealth is eliminated. And if I need to up the protection, now I'm reducing my enjoyment in retirement. And the idea is not to reduce enjoyment in retirement and not to reduce enjoyment today, but it's to take strategic action and get to the same spot, but have more benefits, more protection, less taxes, less risk, right? So when I'm in this equation, if I'm looking at this concept, if this is the strategy where we said, I don't have the 3% compounding on the wealth in here, this person gets to 11 million, right? The fees compound from $4,000 to $117,000 in the last year of this equation. And the fees aren't over at that point, by the way, right? They keep on going, but the cumulative fees were $1.6 million over the 30-year time frame. The cumulative taxes at 20%, $2.6 million. Negative. Now, if taxes go up, how does that happen? If fees are higher, and we're a registered investment advisor, like we charge fees, but the idea is those fees have to be, the strategy has to be minimized in the long run. Like you have to go macro, you have to go big picture, you have to have a peripheral vision of everything that's going on in your wealth and what's leaking. You can't just focus on one side of this, right? And what I see all the time in the industry is, look, the mutual fund, our superior mutual fund did 12.42 average rate of return. My question is, what's the actual? Volatility adjusted returns, tax efficiency of it. There are literally funds and strategies out there that dump ordinary income tax on you. I buy into a mutual fund. It's holding a large stake of a highly appreciated asset. Great stock. And the managers decide to sell a chunk because there's a massive liquidation because they're moving to a more efficient structure like an ETF, right? So what happens is I own the mutual fund and the mutual fund realizes the capital gain and I get hit with my share of the amount of shares that I own of that mutual fund. But let's say I put in $100,000 into the mutual fund and it's worth $100,000 because the market was flat, but they sell something that realizes a $20,000 gain in my portfolio. Check my facts. Can that happen? 100%. But now I got to pay tax on something that I didn't actually gain. So you really got to understand what you're buying and what you're doing. But what the promotion is on the wrong decisions. It's like follow the average rate of return. Bullshit. Okay. Doesn't happen. Ignore taxes. Nobody can ignore taxes. If you have earnings, you're going to pay taxes. Well, you have a choice of how you pay those taxes and how much tax you pay through strategy, not through, you could put it in an IRA, you can put it in an annuity, but that just does different things to your taxes. It's deferring the tax to a spot in the future. Like the tax liability doesn't go away. If I put $400,000 and it grows to 10 million in an asset that was tax deferred, the tax deferred tax liability on 10 million, let's just do the math, it's roughly $4 million. So if I have a $10 million IRA on my asset and I want to leave the country because I'm pissed off at who got elected, you got to pay your taxes first. It's 37% plus the state that you live in, plus Medicare tax. You're talking 50% gone, 5 million before you leave, sir. Thank you. Right? So don't get fooled by deferral versus current tax. There's a combination of all these things, right? I can put money in a Roth. I can put money in different vehicles. I'm limited to what I can put in these things. And if I'm going to do a Roth conversion, and I'm thinking about this, well, I want to convert $100,000 of my IRA to Roth today. I got to take $30,000 out of my other money. So right now I have $130,000 compounding example, and I'm going to move money to a Roth, but I'm going to give the government $30K now. What's my opportunity cost to convert that to Roth? Whatever the 30,000 could have been earning for the next 20 years. When's my break even? Most people aren't thinking that way. Now, I like Roth conversions in certain circumstances, right? I'm not saying this is bad, but what I'm saying is you need to look at the big picture. And if you don't look at the big picture, you're not understanding. And what I wanted to do today was to get really into the depth on buy term, invest the difference, and how you're getting led down a path that you're not going to be happy with when you're in your retirement. You'd be much happier to have an element of your plan as permanent insurance, knowing that you can fully enjoy your capital and pass the maximum on to your family and reduce your taxes and reduce your risk. That's what you want, right? So most financial plans increase taxes, increase risk, increase fees and costs, decrease savings because of those increasing costs, right? Have less protection, have less retirement income, and pass less to your family. That's what's actually going on. I want to flip the switch. Have less risk, pay less taxes, pay less fees and costs, have more savings, have more protection, have more retirement income, and pass more to my family. That's what I want. If you want this or you hate this, give us feedback. Share this. Like this. Call us for a wealth curve conversation, a free, no obligation conversation about your wealth, your decisions, and get strategically thinking. It's 40 minutes into this podcast. If you're still listening, thank you. If you're not listening, oh well, it's your loss.